Hey guys, my name is Mike Boyd, this is the Money Flare, and today I'm going to be talking about inflation. It's a topic that's been on everyone's mind ever since we started seeing things like the price of lumber resemble the chart of a crypto or meme stock going absolutely vertical this year. And it's not just lumber. Take a look at copper or corn, soybeans, used car prices, home prices. They're all going up, and it seems inflation is everywhere. It's in news stories and articles and magazines, and even the Federal Reserve released a video last week where they used Legos to explain inflation. It seems they took the video down, but luckily for us, nothing truly ever disappears from the internet, so I found a copy of it on a Spanish financial news website.
In life, you buy things all the time.
Huh?
You probably notice that gradually the cost of items tends to increase. This is known as inflation. But what exactly does inflation mean?
Now, I definitely can't compete with Legos in terms of entertainment value, but I do want to attempt to tackle this massive topic in greater detail than what I've done previously. Anyone watching this channel would know that I've been talking about inflation a lot, how we're in a period of increasing inflation and increasing growth out of the depths of the COVID recession. But the big debate right now is whether or not the inflation that we've seen is transitory, meaning is this just a short-term spike, or will inflation persist for a while? Getting on the right side of that debate is probably the most important thing you can do for your portfolio at the moment. It will determine how you should be investing over the next few years. So it's important to evaluate all the arguments and to figure out which side we should be leaning towards. I'm going to be splitting up this inflation topic into two separate parts. Today's video will go over exactly what inflation actually is, what causes it, and how we measure it, and all the issues related to that. So this is definitely aimed at more of a general audience for really understanding inflation. But even for those who already have a good understanding of it, I'm hoping that it'll be a nice refresher. I'll be releasing a second video later this week or maybe early next week, which will delve into what the future might hold. Will inflation be transitory in my view? And I'll go over how I think you should be invested. I'm going to be focusing on the big picture of inflation rather than getting into the weeds like I will in this video, because I think a lot of people forget the overall context of where we are right now in the long-term multi-decade cycles. And so I'm hoping to make things a bit more clear and to help anyone watching to navigate these tricky times in markets. So let's get into it. The dictionary definition of inflation is that it's a continuing rise in the general price level, usually attributed to an increase in the volume of money and credit relative to available goods and services. That was a mouthful, but basically in general, it can be seen as a decline in the purchasing power of money. So how our money buys less things over time because the value of that money goes down over time. But that definition leaves out a lot of the nuances of inflation. In reality, inflation varies from person to person, and there are different types of inflation that are important to keep in mind. First, we have monetary inflation, which refers to an increase in the broad money supply known as M2 money supply. So in other words, the amount of money in the financial system goes up. Broad money supply, or M2 money supply as it's commonly known, is a measure of the amount of money in our financial system, and it includes bank deposits like checking and savings accounts, as well as physical currency in circulation. Here's a chart of the M2 money supply in blue and the year-over-year percent change in red. There are typically two ways that the broad money supply can increase. First, banks can lend money into the economy and supply credit. This creates money since when a bank makes a new loan, they are creating a deposit in their customer's account. So they're not transferring money, it's actually money creation. And that's a huge topic by itself, which I'll have to save for a future video, but just know that when banks lend money into the economy, they're actually creating new money, and that increases the broad money supply. And secondly, governments can increase the money supply by running large deficits, so by issuing bonds and injecting that money into the economy while central banks pay for that deficit by essentially printing money to buy that government debt. Now, central banks aren't literally printing money when they're buying government bonds and doing quantitative easing, unlike the infamous money printer meme would suggest. They are buying the bonds from banks and issuing them bank reserves, which act like cash and against which banks can lend. So it's not directly printing money, but the effect for all intents and purposes is the same. Quantitative easing is a huge topic, so I'll leave it at that. So let's recap. Monetary inflation is caused by an increase in the amount of money in the financial system, known as broad money supply. And this increase in money can be as a result of banks lending into the economy or governments taking on debt and injecting it into the economy paid for by central banks printing money. And the key variable here is the growth of broad money supply. The second common type of inflation is what most of you might be familiar with, which is CPI inflation. CPI refers to the Consumer Price Index. It's the primary way that governments measure inflation. It's essentially a basket of goods and services that the average consumer will buy. There are 280 different categories that make up the CPI, and each price is weighted according to their level of consumption. So if the average consumer buys a certain good or service more often, it will have a larger weight in the basket and have a larger impact on CPI. Think of things like food or rent that people pay for on a consistent basis. In fact, rent is the largest component of CPI. But on the other hand, you're not buying a new TV every month, at least most people aren't, so it doesn't affect the index as much. So CPI is a basket of goods and services that the average consumer will buy, and tracking the price of this basket gives us an estimate on what the level of inflation is, how much our money is losing its purchasing power over time. The last type of inflation worth mentioning is asset price inflation. It refers to the prices and valuations of financial assets increasing over time, so things like stocks, bonds, real estate, and gold. Asset price inflation usually happens during periods of high wealth concentration and low interest rates. If a lot of new money created in the financial system gets concentrated among the top 10% of society, so the really rich of society who already have most of their needs met, then they are much more likely to speculate with that money and buy up financial assets. The opposite is true if that new money ends up in the hands of the average citizen, who would be much more likely to increase their consumption and lead to CPI inflation as a result. This last point is key and important to keep in mind going forward. When we have monetary inflation and the broad money supply increases, so there's a bunch of new money created in our system, we have to follow that money. Where is it going? Is it going towards buying assets or is it going towards consumption? Understanding the flows of money is important for figuring out what type of inflation that we will see as a result. So those are the three common types of inflation, but the one that I'm going to focus on for the rest of this video is CPI inflation. And I'm going to refer to it just simply as inflation going forward, because it's the inflation number that everyone looks at and uses to drive their investment decisions. How the market anticipates inflation is what matters most and will determine how you should construct your portfolio going forward. There are different ways to look at inflation. Remember that it's just the increase in the prices of goods and services in the economy. And we measure inflation as a percent change, but the magnitude, the direction, and the duration of that change matter. Take a look at the long-term chart of CPI. In blue is the price of the index, and in red is the year-over-year percent change. Over the past 100 years, CPI has generally increased. The year-over-year change has almost always been positive. Prior to 1950, it was much more volatile, but overall, it's important to note that inflation 90% of the time is positive. When inflation goes negative and prices fall, like what we saw in the Great Depression and during recessions in the 1940s and 1950s, most recently in 2008, we call that deflation. Prices are going down, money is gaining value, and that usually coincides with a major market or economic crisis. When inflation is positive and increasing in magnitude, we would call that an inflationary period, secular inflation, meaning it lasts a long time, where inflation is elevated and trending up. We saw that happen in the 1940s, and we saw it all throughout the 1970s. When inflation is positive but decreasing in magnitude, we would call that a disinflationary period, secular disinflation, where inflation is low and trending down for an extended period of time. We've been in a disinflationary environment ever since the 1980s, so for 40 years now. The CPI calculation has changed multiple times over the years and has a few adjustments to it that are designed to bring down certain prices, and for that reason, many people believe CPI deliberately understates the true inflation rate. House prices, food, healthcare, and college tuition are all rising faster than CPI, and they make up the vast majority of the typical middle-class expenses. For example, Shadow Stats publishes the original CPI calculations without all the recent changes, and they estimate that true inflation is around 8% higher than the CPI. The Big Mac index is another interesting alternative inflation indicator. The price of making a Big Mac is pretty representative of the overall prices in the economy. There's beef, oil, flour, and embedded in it are also real estate costs and wages, since McDonald's has to make a profit from selling Big Macs to offset their real estate and employee salaries. And so tracking the price of a Big Mac over time could be a pretty good gauge of inflation. And like Shadow Stats, it's been rising more than CPI, suggesting that true inflation might be higher than what we think. Between 1990 and 2020, CPI rose roughly 2.5% per year, the Big Mac price went up 3% per year, and broad money supply went up 5% per year. Most importantly, CPI excludes home prices from the calculation. They use rents instead because they want to measure the cost of shelter and not the speculative housing market. But buying a home is possibly the most important and significant cost to most people, and the median home price has outpaced CPI significantly. Over the past 3 decades, CPI went up about 100%, while the median home price went up 180%. And this is considering the size of the home too, so the price per square foot has gone up significantly. It's hard to say how accurate CPI actually is. If you account for the fact that the typical goals of owning a home, having kids, sending them to university, buying a car, going on vacations, eating healthy, all the costs associated with those life goals make up around 60 to 70% of the typical household expenditures, and they've all gone up more than CPI. So the average person might be experiencing higher inflation than what's reported. But even if it may be flawed, CPI is the primary measure of inflation, and so we work with what we've got. And from an investment perspective, it doesn't really matter how accurate it is anyway, because what matters most is how it's changing and how the market reacts to those changes. Now, it's important to go into the drivers that affect inflation, and there are many factors that can cause inflation, disinflation, and deflation. And each good or service has its own supply and demand balances that can affect the price. So it's hard to really come up with a definitive list of causes, but for general CPI, there are some major factors that would affect the overall price levels in the economy. Let's cover deflation first, because as I said before, we've been in a disinflationary period for 40 years where inflation has been decreasing and has stayed quite low. So clearly there are deflationary forces right now that are larger than the inflationary forces. There are four main drivers of deflation in our economy. They are debt, demographics, globalization, and technology. First is debt, and I'm sure it's not a surprise to anyone that the world right now is extremely over-indebted, especially after COVID. Just look at the chart of federal debt to GDP in the US. It's at 130% right now, all-time highs. So that means that the total value of government debt in our system right now is 130% of GDP. And debt is just an increase in current spending by pulling demand from the future into the present. So something that you normally would have to have saved money to buy, let's say a car. So saving $8,000 over a few years to buy a new car. With debt, you can pull that demand from the future into the present and slowly pay it off over time. So governments going into debt and injecting it into the economy can give you a short-term economic boost, but if that debt used to stimulate the economy doesn't actually generate enough of an income stream to pay off that debt, then it acts more like a burden and it slows economic growth, leading to deflation and lower prices as people tend to get trapped in trying to pay off debt rather than consuming and putting money into the economy. There is a point when too much debt is crippling, and we seem to have passed that point by now. The second driver of deflation is demographics. In the West, our population is aging, and once you reach retirement age, your consumption drops significantly. So economies with aging populations will have fewer workers able to generate economic growth and increase productivity, and will have decreasing consumption. And since consumption is 2/3 of US GDP, then it's a big deal when consumption drops off. So the aging populations that we have in the West act as a deflationary force in the economy. But demographics can be inflationary as well. If a large generation of young workers come into the workforce and enter their peak spending years, then that can cause inflation, which is part of the reason why the 1970s were so inflationary. Baby boomers were coming of age and all entering the workforce simultaneously, buying homes and appliances and other durable goods, and so the overall demand for goods and services increased, leading to high inflation. But right now, we don't have that situation, and our demographics are definitely deflationary. The last two drivers of deflation are globalization and technology. Companies being able to outsource manufacturing and take advantage of cheap overseas labor and automation help to keep prices low. And it's the same thing for technology. Any technological advance that allows us to make products more efficiently and for a cheaper price will naturally act as a deflationary force in the economy. And we've seen the rise of globalization and technology for the past 30 years. Manufacturing moved to places like China, while the personal computer, the internet, and smartphones all made us significantly more productive and reduced the costs in many aspects of our lives. Just think about how at one point in time, not even too long ago, let's say 1995, if you wanted to find information, you had to go to a library and look in an encyclopedia. But now you can just Google it on your phone in 5 seconds. Think of all the costs and time savings that has caused. It's important not to underestimate the power of technology. So I've gone over the main drivers of deflation, and they counteract the inflationary forces in our economy. Whichever side is more powerful will be the one that determines the overall inflation levels. But what are the factors that would affect inflation and cause an increase in inflation? Supply chain issues would be the first factor that is worth mentioning, and it's what we've seen so far following COVID. When supply gets squeezed and goes down, but demand stays the same or rises, then anyone who has a basic understanding of economics could tell you that prices will go up. And that usually is a short-term cause of inflation, because once the supply chain is fixed, then prices usually correct back down. You can see this relationship by comparing CPI and PPI, where PPI is the producer price index, and it tracks the prices of commodities that producers use to make products. And over time, the two indices match up. So as commodities are increasing in price, it usually trickles into other prices because the cost to make them and transport them goes up. So supply chains and the cost of commodities can affect inflation. A more persistent driver of inflation is increases in the broad money supply, so monetary inflation, which is what I talked about at the beginning of the video. And I've talked about this a lot in my previous videos, but when the amount of money in the financial system increases, it has usually led to increases in inflation. The concept is that more money is chasing the same number of goods and services, so the prices will go up. The chart of M2 money supply in the US versus CPI very clearly shows this relationship. There are a few exceptions, however. In the late 1800s, there was high money supply growth but low inflation, and that's because the US was going through a technological revolution and massive economic growth. So in this case, the deflationary forces of technology and increases in productivity outweighed the inflationary force of increased money supply to keep prices low. We saw something similar in the late 1990s when we had another technological revolution with the creation and widespread adoption of the internet and computers and smartphones. But other than these exceptions, the relationship between increases in broad money supply leading to increases in inflation is very strong. And I'm focusing right now on the US, but this relationship can be seen in other countries as well. And remember what I mentioned at the beginning of the video. It can be either banks lending into the economy or governments running deficits, which could increase the broad money supply. One factor that people always say has an effect on inflation is money velocity, which is the number of times per year the average dollar is spent. So it can be thought of as the speed at which money is turning over in the economy, how much money is propagating, being exchanged from one person to the next. A decreasing or low money velocity is typically seen as deflationary since money isn't moving around to raise prices and cause inflation. But when looking at the data, that narrative doesn't really hold up. It actually appears money velocity has very little effect. For example, in the late 1800s, there was very high money velocity but low inflation. And same thing in the 1940s and the 1970s. Money velocity was steady during those inflationary periods. Now, I'm not saying money velocity has no effect on inflation, it just doesn't seem to be the major driver based on the data, at least with the way that we're currently measuring velocity. Now that was a bit of a slog, but I think it's important to really understand inflation and what factors drive it in order to more appropriately position your portfolio. So getting through the more dry information is really necessary, and I hope I was able to be as clear as possible. The really important topic, in my opinion, is whether the inflation we've seen recently will last. Will it be just like every other transitory inflation spike over the past 40 years, or will it last longer? Think about the implications, because if inflation does last longer, then that would be the first time that we've seen that type of environment since the 1970s, and so we'd be in a completely new situation. Most experienced portfolio managers have never dealt with that type of environment before. We've had disinflation for 40 years, so this would be a real paradigm shift that no one's prepared for, and so I really think that getting on the right side of this inflation debate is so important right now. So in the next video, part 2, I'll be giving my views on which side I stand on and what asset classes do well during inflation and deflation. Hopefully I can help anyone watching to better position themselves to what may come. So please stay tuned for that. Thank you again, as always, for watching. Be sure to like and subscribe. Be careful in these markets, and I'll see you at the next video.